My name is Sophia Platt. I'm the founding partner of Bridge Funding Global. We are a top highly curated two-sided marketplace for the top performing emerging managers from primarily venture capital, but also private credit and private equity. I'm also an investor across all alternatives. I love private credit and venture capital. I will talk about it later today, and I'll be your moderator today. Thrilled to be here. Before we dive into the macro outlook, which is a very exciting time, right, to be talking about macro? Very exciting, thanks. Could you please, dear speakers, introduce yourselves, your firm, and tell us more about which asset classes are you currently focused on?
All right, I'll start. And fun fact, I got to know Sophia very recently, and I've actually joined the selection committee for Bridge Global to help connect female founders with female allocators and promoting the space of emerging VC and private equity. So looking forward to working together.
Honored to have you.
Yeah, thank you. But in my day job, I'm part of the multi-asset group at Northern Trust. We are a 1.3 trillion asset manager. Also provide wealth management and custody services. So very well known. If somebody doesn't know about the firm, happy to talk more after. But I've only recently joined a few weeks in with the goal of building out investment capabilities for our wealth and outsourced CIO platform.
All right. Hello, everyone. My name's Jeffrey Cleveland, spelled like the city. Head up our economics team at Payden Rygel, which is headquartered right across the street, the Wells Fargo building. We manage about 170 billion for institutional clients, mostly in fixed income. And there's a lot of space up here in the splash zone. Can move forward.
I love the energy. Thank you, Jeffrey. Would like to open up with general macro context. How would each of you describe where we're at in the current micro cycle? Soft landing, slowdown, or new regime? What single data point or trend you both are watching most closely to guide your outlook, and how does it impact your portfolio construction in terms of multi-asset allocation?
All right. So macro, the Payden approach, I would say, is to look at all possible scenarios that we can envision. It's more of a creative thinking exercise than a forecast. So I think right now we've considered about 6 different scenarios for the next 12 months. So everything from a stagflation to a hard landing to a reacceleration in growth, such that the Fed has to stop cutting and start hiking. We thought about all those different scenarios. I would say there are 2, though, for me that are the most probable. So not every scenario is that likely. So the two most probable for me would be a continued situation like we currently have, where the economy is growing. It's really, I would say, a tech-fueled growth. Inflation is continuing to moderate, but you're not seeing that much job growth. So I would call that a productivity growth scenario. The second scenario I would point to as maybe the second most likely would be a recession. And the reason for that is, for me, as a bond market nerd, bond market economist, the most reliable data is the labor market data. And job growth has slowed quite substantially, especially this year. The 3-month moving average of job growth, that would be the one signal, Sophia, that I would point to. It's 29,000 for the data that we have released through August. It's very unusual to see job growth slow that much outside of a recession or on the cusp of a recession. There's been 2 instances in history where job growth slowed a lot like that and then picked back up. So I would look at the mid-1960s. I'm not sure that's relevant. Some of you may feel otherwise, but the mid-1990s would be the second episode. That might be more relevant to the current environment. Job growth picked back up and the economy continued to grow. So it's really those 2 scenarios that I think will probably play out, one or the other, and it'll be the job growth that defines which way it breaks.
Thank you, Jeffrey. Dee?
So because I'm new at the firm, what I've learned is that there is no one house view. There are multiple house views, and that's what inspires debate. So kind of coming into this year, my view was firmly slow down. But we don't have data for September, so we don't know where the Q3 GDP's estimate is going to be. We don't know where inflation and PCE are going to be. We can guess through other data points. But I think as I think about slowdown, one thing that's striking to me is this K-shaped economy that we are in right now, and how there are parts of the economy that are in slowdown, there are parts of the economy that are in new regime, and there are parts of the economy that are experiencing that stagflation. So it's really, where do you look, and you can find the data to prove which market we are operating in. And for me, what's interesting is if you look at the US unemployment rate, so I know you quoted some labor data that's most widely looked at. I also look at the data for the 20 to 24-year-olds, and the US unemployment rate for that cohort is getting close to 10%. So it's pretty high. The young people can't find jobs story, obviously everybody cares about that, because again, what does that mean about future of the economy? The other piece that I've been watching is impact on inflation, so the experience of inflation versus the inflation numbers and what is included in inflation. So things like elder care is experiencing a 7% inflation rate because of how much of that is suffering labor shortages because of all the immigration challenges. I was recently at a AGM of a timberland farmland manager, and they have a very bearish view on the sector because of the impact of the immigration changes. So I think in terms of, like the question was like, where do you think the economy is? The answer is, again, based on the data points, where do you live and where you are and what sector of the economy you're in and what demographic you're in, you can find part of the economy that part of that trend that works. But one metric that I'm looking at right now, like especially as we are in earnings season, is earnings surprises. And what I have seen is, since COVID, actually, earnings surprises have been a much better predictor of the market than any of the macro data. And if you look at this quarter, one of the notable changes is that the market is actually rewarding companies more than usual for good earnings surprises and punishing companies even worse than usual for negative earnings surprises. So again, like it's intensifying in terms of the effect that we are seeing of something like earnings. And then as you kind of think of all this data, one quote that I keep coming back to that I heard Ray Dalio say recently was, hope is not a strategy. So, how do you take all this information and put that in a portfolio context? And again, like we debate and we will debate, like, is AI a bubble or not a bubble? But semiconductor stocks are at all-time highs, and global equities, I think 60% of global equities are at all-time highs. US is 2/3 of that. So you can't step away from what's really moving the markets. And one recent change that I have seen in how we think about portfolio construction and multi-asset is we used to be asset class investors, and now we're becoming stock investors again. So starting from like FANG to Magnificent Seven, and now the newest term that I heard, I don't know if anybody else has heard it, is MANGO, which stands for Microsoft, Anthropic, NVIDIA, Google, and OpenAI. So that's the new term, which is MANGO, and you have to know these stocks very, very deeply if you want to be an investor in today's market.
Brilliant. MANGO. Thank you, Dee. You both have touched briefly on inflation and rates. Do you think that central banks have done enough, or could sticky inflation force another round of tightening? How does a higher for longer rate world reshape your portfolio strategy between public and private asset classes?
So I mentioned two scenarios earlier, right? The productivity-driven and the recession. I think, in my view, in either of those two scenarios, you get a similar inflation result, which actually inflation moderates over the next year. And one way I like to think about it is maybe will resonate is just thinking about the attribution, what has driven inflation year to date in 2025. And so you can look at core PCE, the Fed's preferred inflation gauge. And I would say the big driver of upward pressure on inflation has been goods. And we know why. It's tariffs. Tariffs went up. That has fed through into goods prices. So on a year-on-year rate of change basis, probably about 30 basis points of upward pressure from goods. There's two other major categories in core PCE, though. Non-housing services and housing. And both of those categories have disinflated year to date and roughly offset the upward pressure we've seen on goods. So that's really why it looks like it's kind of an illusion on the surface that core inflation is hanging out at 3% because of that upward push from goods, offset a little bit from the other two categories. My bet over the next 12 months is that I don't know exactly when. At some point, this tariffs stuff will be behind us. Tariffs are kind of like a tax. It's a one-time. It'll feed through. And then I would say by the second half of next year, that will fade from the core data. And then what will matter is, well, what happens with non-housing services and what happens with housing services. Non-housing services closely tied to the labor market. The labor market's cool. Non-housing services tends to cool off. And keep in mind, non-housing services is a catch-all. It's like 50% of the index. It's everything from haircuts to healthcare services. Housing has been a big problem, big sticky factor in core inflation. We're finally starting to see that cool off. Rents, owner's equivalent rent. I think that will continue in the next 12 months. So I think a year from now, we'll be closer to 2% core inflation than 3% core inflation. And then this could be a big story. So you asked if have central banks done enough? Yeah, I think they have. They've done as what they can. They raised rates, and inflation is cooling off. It will just take a bit longer, but we'll get back closer to 2%.
Thank you.
I mean, yeah, I'm not the inflation expert. That's Jeff. But I'll just add from a impact on kind of public-private markets, right? Obviously, everybody in private equity land is so happy. And has a positive outlook because the Fed is starting to cut rates finally. So the kind of trend had shifted where you really had to be a value add provider in private equity and have companies generating EBITDA growth because you couldn't rely on the valuation and multiples expansion piece anymore. So maybe finally we will have some comeback because of that in private equity. So there is some potential for buyout specifically. But, like when I look at public markets on the other side of things, and again, like lower rates are good for risk assets across the board. The question is, how do you invest in them? And when you invest in private equity, you do it through funds. When you invest in public equities, do you do it through funds? This year was actually so terrible for active funds. I saw this chart by Jeffries that only 22% of active funds outperformed their index in public markets, and you can't, I think the point they made was that you can't just blame AI for that because a lot of the managers also missed companies, non-AI companies that produce double-digit returns, especially in financials, like Morgan Stanley and Wells Fargo, also in healthcare. So even though healthcare is a really bad sector from an earnings standpoint, there have been some standout names, right? So it's really changes the shift in terms of how do you invest as rates come down. You want to get allocation to more risky assets. Where do you go for those risky assets? Is it through managers? Is it through direct investments?
Brilliant. And speaking of excitement and on the private markets, looks like the IPO pipeline is finally coming back. What does that signal about liquidity and risk appetite? Are the current valuation realistic, or are we having a deja vu from 21? Which sectors, AI, healthcare, energy, are leading this rebound?
Yeah, you can talk more about that, Sophia, because that's your world. But, I was kind of disappointed by how the IPO rallies almost ended because of the government shutdown, right? And even with the SEC kind of giving this lifeline, not a lot of companies are able to use it because it creates more price volatility in how they can come to market. So let's see, because post-November, we're not really going to see a lot of IPOs. But we had a really good run. Investment bankers made a lot of fees this summer. But the bigger point is outside of the big names like Figma and CoreWeave and Circle, right? Like the private equity backlog is still pretty bad. So I think it's like 12,000 company, over 7 years of backlog. So it's really about what happens to those companies. Are they going towards CVs? Are they really going to IPO? Are those companies just going to stay private forever or for much, much longer than anticipated, sell to other private equity firms? And how does that generate liquidity? So that's the big question mark in front of LPs, because that creates a challenge of, as you start building our future portfolios, you have to think about liquidity as a very integral part of creation of those portfolios, that in terms of the extension of timeline, does it really warrant that investment? Because if you're expecting like a 2x, 3x MOIC over, you thought it was 10 years and now it becomes 15 years, you're not really getting that much better return than public markets. So I think people are really questioning in the light of, even with the amazing news around IPOs and optimism, what does it really mean in terms of the bigger chunks of the portfolios which are still in private equity buyouts?
Totally agree with you. And we've seen definitely some cautious optimism about the IPO market after the ones that you mentioned. More private equity, private venture capital funds have been going to market, and we've also seen a lot of activity on the secondaries market that we've discussed earlier. A record amount of transactions on the secondaries market. Even conservative investors like myself getting overly excited to look at some of the deals. Dee, do you have a viewpoint on that?
On the deals
on the secondaries market overall, is it like too hyped? Are there just AI companies driving all the activity there? How is the pricing done? Is it balanced?
Yep. I think we were talking about this before the panel. We are both very excited about the secondaries market, but again, like where I am cautiously optimistic in that market is around a few areas, which is pricing. So a lot of the secondaries portfolios have gone into evergreen funds and the perpetual vehicles. And the challenge is that those funds actually have been paying more in terms of, so there was a report by Campbell Lutyens that talked about how they are overpaying, like evergreen funds going into secondaries are overpaying by over 400 basis points because they need to get allocated very quickly. Mm-hmm. So I think it's the market, the changes in the market are very positive. More LPs are engaging with secondaries. It used to be that you only engage with secondaries when you're in a stressful scenario and absolutely need liquidity, but now more and more LPs are doing that on an ongoing basis to price their portfolio. So it's definitely a very good tool that's becoming available to LPs and as well as GPs in the form of continuation vehicles to spin out their trophy assets. But on your point, the magic variable is pricing, and at what pricing are you getting access in what vehicle?
Completely. And I've seen GPs produce completely differential terms to different allocators, and there's absolutely no transparency on the market. You can send the same term sheet to different LPs and set up your own terms if you manage to get into big hot deal with a big name or a big founder on the cap table. Last question on the private markets before we move towards geopolitics and tariffs. Private markets have seen a dramatic shift over the last couple of years, yet each segment is seeing almost like a different cycle of development. How are you seeing the capital flow shifts between private equity, private credit, venture capital, and buyout?
Yeah, super interesting because again, with private credit, there's, you're also seeing the growth of credit secondaries, by the way. So, but largely what's in the headlines around private credit is news about, default risk, and Jeff from a fixed income shop can talk more about that. But, most of the banks have come out and said that the charge-off ratios that they're expecting are on a portfolio level are not going to be higher than what they expect. So outside of the subprime auto sector, where I think the rate of delinquencies are at an all-time high, but that hasn't really bled out into other parts of the other parts of the banking portfolio. So, again, we're not expecting a crisis or systemic risk situation here, but where more and more credit and private credit is being used, again, is as a liquidity tool. Again, and this is where credit secondaries also have a role to play because they have even shorter duration. You can get allocated quickly. So we are starting to see some interest in credit secondaries as a way to play that liquidity theme.
Great, thank you. Let's move towards geopolitics and supply chains. How are tariffs, regional alliances, and reshoring trends reshaping global capital flows? What does nearshoring mean for the future of manufacturing in the U.S.?
Well, tariffs, they're having an effect. It's probably less of an effect than people thought. Right after April 2nd, there were a lot of calls for recession, 95% chance of a recession, inevitable recession. We really haven't seen that. Instead, we're seeing the effective tariff rate settle in around 10% in the latest month of data, which is up quite a bit. If you go back a year ago, it was 2%. So it's definitely, I think, a tax on imports, a tax on consumers, a tax on businesses. It's a drag on growth. It's just not as much of a drag as people had envisioned, and I think it's been offset somewhat by this tech or AI spending boom that you're seeing. Also, I think it's interesting to note world trade is, I think, 3% above year-ago levels. So actual world trade activity is still looking quite nice. The routing of trade has changed somewhat, but the tariffs were not the end of the global trading system or the end of the global financial system, or many of these stories that we heard right after the tariffs were announced. So I think that's important as well. I wanted to go back to the IPO stuff though, because from macro side, I was thinking you talk about liquidity and IPOs, and in the macro side, we always think of financial conditions. Are financial conditions too easy? And then if they are, why is the Fed cutting? So I think that's perhaps a valid concern. I would just say from our perspective, when we think about what the Fed funds rate should be, so they've already cut it 100 basis points. So we're now 375 to 4, and as of yesterday, we would think, where is unemployment going and where is inflation going? And that kind of helps you gauge what the appropriate Fed funds rate would be. And as I mentioned earlier in my scenarios, I do suspect the unemployment rate will creep a little bit higher and inflation will moderate. And that will justify a lower Fed funds rate. And if that happens in a scenario where we're not in a recession, they could be very good for risk markets. And we always think about credit spreads in bonds, but credit spreads are tight or narrow. Valuations are rich, however you want to characterize it, but they can remain narrow for longer, or they could even tighten in that kind of liquidity backdrop. The other thing on liquidity, from macro, putting macro hat, the Fed ended QT, well, is going to end QT on December 1st. So this, at least on the margin, was a pullback in liquidity, and then they're going to pause that, and then they'll probably add to the size of their balance sheet, I would say pretty soon. Within the next few months, the balance sheet will start growing. So this will be a net liquidity add, I think, putting bank reserves in, buying T-bills. So this could also be a factor for financial markets.
Great. Thanks so much, Jeffrey.
I think if I can just add to that, like on the credit piece, what you mentioned, right? Like, I feel like I didn't answer the question, which was, with the spreads being so tight, I think a lot of the interest in private credit is also shifting and shifting away from a yield-based approach because the spreads are not compelling anymore. And so I think what's interesting is, like, where do you go to get yields in today's market is like a big question for investors, right? Like, what are the asset classes where you can get yield, like, especially if you do play the scenario where, you do kind of see that recessionary market, like, where do you go to get yield, and where do you go to get the hedge? And that's probably leading into your next question.
Definitely it is, especially as the US dollar weakens. What's the so-called modern safe haven for LPs? Is it gold? Is it silver? Those commodities, private credit, cash streams, and how should investors think about currency exposure and inflation protection in portfolio design today? What are your thoughts?
Okay, so where I would start with that, Sophia, is what drove the weaker dollar year to date? Because this has been one of the worst years so far for the dollar, the DXY, since I think if you go back to 1970. And so there were a lot of stories about, Trump wanted to depreciate the dollar, or it was the end of the American exceptionalism, the end of the U.S. dollar as a safe haven currency. I don't think that's really what's driven it. It was the fact that growth expectations in the U.S. fell pretty sharply after April 2nd. And then if you plot that, I have a nice chart of this if you want to see it, the dollar weakened. So it's really that story. The dollar has found, I think, a little more solid footing as growth expectations have come back up, in recent weeks. So I would just keep that in mind. If we do, in my two scenarios, I got to keep pitching my two scenarios here. It's going to come in the recession scenario. I do think treasuries will be your safe haven. The dollar will strengthen. So you mentioned where to find yield. You can still get roughly 4% on a 10-year treasury right now. So you might consider locking in some of that sort of safe haven yield. In a recession, I think that will perform well for you, and the dollar will strengthen. In the other scenario, my second scenario, where you have kind of more of the same, it's possible that if the Fed keeps cutting, we'll have a little bit of a weaker dollar. I just don't think it's a dramatic weakening. I always see on social media this 40% drop in the dollar, and I can't really get on board with those sorts of prognostications.
Hopefully not.
Yeah, I mean, there's a session going on in the other room on stable coins, and we were just talking about how, it's not just the dollar that's weakening against gold and Bitcoin, it's actually all currencies. So the bigger question is, are we moving into a world where there's alternatives to currencies, and like how fast are we moving towards that world? But, I kind of take a step back and, as I think about, like you mentioned, silver, right? Like I think there's other ways to access like hedges to currency exposure through real assets that a lot of investors are piling into. And again, like gold has become really expensive, but silver is a good alternative considering that there is structural shortages and there is demand coming from places other than just the demand for a currency alternative, more from the energy transition and from solar. So that's kind of one market that we've been looking at, but like the way we think about commodities is changing, because commodities used to be kind of a cyclical trade. So I have a Series 3, like I used to be a CTA trader, and you would just do like carry and momentum trades and trade across the curve in commodities, and the whole point was commodities are cyclical. You keep trading them, collect pennies to the dollar until the crash comes, right? But now the view is shifting towards, well, there are strategic commodities. Gold and silver could be one of them. Copper could be another one. I think everything that's the parts of the periodic table that we don't remember could be another piece of those where, I recently learned that rare earth metals are not actually rare. They're very abundant. They're just hard to mine. And the size of the market today is the same as the size of avocado market. So, again, like that's a market that'll continue to grow, and there's a lot of interest, not just from kind of what's in the headlines, the government, but also from family offices and other investors that are really looking to get access to that part of the infrastructure, the AI infrastructure. So yeah, I mean, the role of commodities is just going to change, and the way we're going to trade them and buy them and use them is going to be very different.
The gold story is interesting from a fixed income. I'm biased, of course, but it doesn't pay you income, so not a big fan. I think it made sense. There were parts of the 2010s where real yields were negative. So if you took your nominal yield after inflation, it was negative. Then I think in that environment, maybe gold or some hedge like that made sense. But now real yields in the U.S. are actually quite a bit higher. They're positive. Real yields in the UK, I think, are 30-year highs. So I'm less fond of the gold story. So my team are like, oh, who's buying gold? Central banks are big buyers, but three people, I would say let's say characters in particular, are buying a lot of the gold this year. Russia, China, and Poland. So I think this is less about fiscal or less about inflation hedging or anything like that. It's geopolitical the original question that I dodged. No, it was geopolitical, And it's not about the U.S. fiscal situation. It's not about really hedging against the dollar. It's that they have some geopolitical objectives. Nation states want to preserve their own purchasing power. We saw in 2022 how U.S. Treasury was able to restrict purchasing power if you had assets saved in U.S. dollar in certain institutions. So gold got caught a bid from that. So I think it's more of that story than it's a fundamental story about the U.S. dollar.
Totally. Thank you, Jeffrey. That brings me to my last questions before. I have a lot of more questions, but I want to make sure we open the floor to questions as well. What gives you optimism about markets in 2025 and 26?
I struggled with that one, and because everybody's optimistic, and I want to be devil's advocate. But just like listening to earnings call, this one term struck out at me. It's called nauseously optimistic. Like we say cautiously optimistic, but I think we are in a world where we are nauseously optimistic. But just taking a step back, so I'm part of a book club where we recently reread the book called Chip Wars. And if you haven't heard about it, it's a great book about the history of semiconductors. And I think what I really took away from the book is how much government policy shaped the semiconductor industry. So if you look at the Taiwanese government, they recruited the guy to run TSMC and grow TSMC, and now it's a powerhouse, and all doors to AI and or begin at TSMC. And when you look at the failures, right, with the DRAM and even the European market and Japan market, like they had early wins, but they didn't really take off because they didn't have the support and policy support from the government. So when I take a step back and look at what's going on in the world, and if you see it as a fight for global dominance of the next leg of technology and infrastructure, then the countries that will be the winners of tomorrow will be the ones that have very strategic policy and government support around it. So even though everything that we see in the news kind of comes across as volatility and geopolitics, I feel like there is method behind the madness on part of kind of reaching to that that next stage of who is the dominant power and winner takes all.
All right, when you say the optimism, I think of the phrase American exceptionalism. And I think earlier this year everyone said it's the end of American exceptionalism because of the tariffs and things of that nature, maybe because of geopolitical rivalry. And I just think that it's not the end of American exceptionalism. I think America still remains exceptional, and the reasons why are we're still the home for innovation. It's funny that people said this was the end of American exceptionalism, and then we have this AI boom, which is sort of proving that. Much of the AI compute, if you look at it on a geopolitical basis, look at it country by country, is still U.S. based, the data center capacity. So we're still exceptional. We still have the entrepreneurial spirit, so we're still seeing new firms form. When companies even form in other parts of the world, oftentimes they come here when they want to raise what we were talking about earlier, venture capital. The U.S. still has the deepest and most liquid capital markets. So that really helps. I think that just tells us that we still have more to this American growth story. So despite all the headlines, I'm still optimistic on that basis.
+1 to American optimism.
Well, you have to answer the question too.
I would say that the IPO market has lifted my mood lately, and seeing the deregulation in the M&A activity. More deals are being done, again, on the secondaries market, not promoting anything, but that's what we've been seeing, which consequently affects venture capital and private equity, because even the recession cannot stop the innovation. Some of the most brilliant companies have been founded during the recession times, and I'm sure Jeffrey will give us another history lesson here. By the way, thank you for all the notes. I love history. There is the new momentum, even in San Francisco, where I used to live. Obviously, the AI has contributed to that, but I believe over the last 3 years, that's the most optimistic time when it comes to venture capital and private equity, and consequently to the innovation to startups, because we need this venture dollars to fund the most brilliant founders, and those most brilliant founders are American or come to America to start their companies to raise funds. So definitely believe in the innovation, and the center of gravity is here in the US. And since we opened that AI door, beyond the hype, can AI-driven productivity gains realistically justify current valuations? And how should allocators differentiate between transformative AI businesses and speculative plays?
I don't know how to differentiate, but I do think this is different than the 90s. I remember the 1990s, and there were companies forming, but they didn't really have a product. They weren't making any money. So that is very different than the current environment, right? Also, from a macro side, in the 1990s, we built out a lot of infrastructure, telecom capacity, but even by the end of the 1990s, not a lot of that was used, right? So the supply was out there. You look at fiber optic cable, maybe 3 to 5% of it was actually being used. So there was this supply build out, this infrastructure build out, but there was nothing, there was activity on the internet. What we have now is the opposite, right? I think we have massive demand for compute and not enough compute. So now companies are trying to catch up. So I think it's a bit different story. The other thing I think about is people were telling me in 96, 97, 98, 99, and 2000 there was a bubble and it was going to burst. And it finally did, right? But these things can take longer to play out than people imagine. So I think that's another thing to keep in mind.
I was going to wait to see how Jeff responded to take the other side.
Perfect.
So the other side I would say is, if you look at OpenAI is on track to lose like $27 billion in net revenue this year. So, I mean, how is AI making money is the number one question, right? So is it entirely, obviously like data centers are now a bigger part of GDP growth than the consumer. It's like mind-boggling numbers. But, for every dollar that OpenAI is generating in revenue, it's costing them like over $7 to generate that. So at what point do you hit equilibrium, and then what is the VC market really funding? Because again, we talk so much about, like I talked about Mango and Fangs, like the public markets and Magnificent Sevens have made it very concentrated to invest in equities, but VC market has also become really concentrated with, I think 80% of VC dollars have gone into the top 10 companies. Most of the fundraising has happened with top 10 VCs that are overpaying for those companies in terms of valuations, and the VC market again is becoming more and more concentrated. I think a decade ago only 10% of VC spend had anything to do with machine learning or AI, and now it's close to 65%. So what else is there? So I think we've just kind of created this huge expectation around AI that like really has to come through in terms of some proof of concepts and application in the application layer. And I think, people, again, I get very excited when Amazon cut the white collar part of the workforce to show, well, maybe that's how you generate the profitability and revenue gains. And if you look at, I think, numbers from Goldman and Citi and like really smart people who have looked at this very deeply, like they are expecting huge amounts of growth. So I think Citi said that we would see 80% CAGR in terms of AI revenue, and Goldman's estimate was $8 trillion in discounted cash flow value in today's dollars in terms of how much value will be generated from AI. So it's, I think it's an open question, right? Like in terms of when that happens, like I think people do believe that it'll happen, but the magnitude of the gains and then when it happens and have we overbought the story today, like those are the big questions that people are grappling with, and it's not just something that touches public market portfolios. I think it touches both public and private market portfolios. So when that story, if that story does get questioned, we are going to see kind of a big drawdown. And again, where I started was hope is not a strategy, so we can hope AI will work, but we should also be prepared if it doesn't.
Completely agree with that, and there isn't a shortage of companies being valued at 8x their revenue, which at some point has to be more realistic. Wonderful. Thank you so much. We are opening the floor to questions. Does anyone have any questions? Please jump in.
Also, we have plenty of time, so if you have thoughts on any of these topics.
Please, yes.
I guess we're going to get a new Fed chair. Oh, thanks. So, I mean, it sounds like we're going to get a new Fed chair very shortly. I'm curious, how much should we be focused on that? How important is the identity of that person? Like, is this something we're going to look back in 10, 15 years and say, boy, that was a shift, that was a moment? Or is it just sort of something that markets will focus on when it gets announced and then on to the next thing?
So we always say the Fed is a they, not an it. It's not a one-person run organization. It's a group of people. If you think about, like the president, how much influence can the president have? It's really by appointing people to the 7-member Fed board in D.C. There's potentially one slot on that board opening up at the end of January. And then Chair Powell, his term as Fed chair ends in May, but he could stay on the board for longer. So then it's possible that slot wouldn't open up. So the president doesn't really have that much influence, aside from tweeting. So that could continue. He's been tweeting about the Fed since 2011. If you go back and look at his tweet history, so long before he ran for office. So it's I think there's a limited amount opportunity to influence that. And then you think about that board is part of the 19-member FOMC, so it's a big committee built on consensus. So I don't think putting one person on there necessarily changes it dramatically. And then even the new member of the Fed board that's been on there, Stephen Moran, he still operates in a very similar intellectual framework to everyone else, basically using a Taylor rule, which is what I was telling you all earlier. You can optimize between inflation and unemployment and gives you your Fed funds rate. He uses this same framework. It's just that he has different assumptions. He thinks inflation is not as much of an issue, the unemployment rate maybe is a bigger issue, and that the neutral rate is lower. So, but it's still kind of the same intellectual framework. So I don't sense this is going to be a big watershed moment, in my view. The other thing I always like to say is every president wants to influence monetary policy. Richard Nixon wanted to influence monetary policy. Thank goodness he didn't have social media. Who knows what his posting would have been like. Ronald Reagan wanted, to influence monetary policy. George H.W. Bush, famously, I think he, in memoirs, thought he might have lost the election based on some rate hikes in that period. So, I mean, every president and everyone in this room has an opinion on where interest rates would be. So that's not too unusual. So I think maybe we made too much about this Fed story, or at least the Fed chair story. It's a consensus group. It's a big organization. It's one of the most unique organizations within the federal government, sort of quasi-private, public. Yeah. So it's complicated.
Yeah, and to add to that, if the danger of Fed losing credibility is potential runaway inflation. So if we are seeing more of a disinflationary trend by the time, and if rates are, like if Powell has been cutting rates, although for December, I think the probability came down to 70% from 90%, so we'll see. But, again, like if the rates are in a good place, that the president doesn't feel that it's harming his agenda, and you're not seeing kind of inflation rising to the point that any doubts on Fed credibility can lead to a challenge on that and like lose inflation expectations. I feel like the timing of it may not matter at that point, but to your point, like 10, 15 years later, who knows? We might look back and say, well, that was the moment.
Thank you. Does anyone else have a question or a comment for that matter?
Any asset classes people are invested in that we didn't talk about today? We covered everything.
What gives you optimism? I'm sorry? International markets. Any markets in particular? Emerging markets? Emerging markets?
Well, I mean, the Payden House view on emerging markets is kind of driven from, the scenarios that I laid out, and then thinking about developed rates, and then what that might have on global capital markets. So, if you think the Fed is cutting, and the dollar might be a little bit weaker, then that might argue for looking around the world non-dollar for carry opportunities. We also think that, I mean, it's very case by case, country by country, of course, but the general, I think, macro view from the firm is that emerging markets are on better footing now, fundamentally, than they were even a few years ago. We're in we call it an upgrade cycle, right? There's some outliers from that, of course, but so it's a good opportunity. If you think of the global capital cycle, Fed cutting, usually it benefits other areas around the world. So it could be that kind of carry story that plays out. That's in the more benign scenario. The recession scenario, I think, is more challenging. I think, again, that's an argument for U.S. Treasuries and for U.S. dollar. So that's how I would answer that. Yeah.
I defer to Jeff because I invested in the Payden emerging market
wow.
strategy.
We have a client. This is incredible. I thank you for your business.
But no, I mean, I feel like it ends up being like a China story, right? Like when people look at broad emerging markets, and I think there is a lot of question mark this week around, what the direction of travel is going to be in terms of U.S.-China relations. So like that's going to drive a lot of the sentiment. But outside of that, I think there are pockets of opportunity within. If you're willing to go into private markets specifically, I think there are more pockets of opportunity because the U.S. market feels a lot more saturated. Like there are, what was the quote that came out recently? Like 19,000 private equity firms and 14,000 McDonald's. So like we have so many funds out there. So where do you go for opportunity? Do you go to Europe? Do you go to Japan? Or do you go to emerging markets? So I think there is, the development cycle is different in some of those economies, and obviously, as we were very bullish on exceptionalism, U.S. exceptionalism and innovation in the U.S., but I think innovation is not just a U.S. story. I think it's going to become more of a global story as well. So it's really going to matter, like, where do you see that innovation and which countries are driving that? Where we are watching is, again, like that theme of where is the government policy support the highest when it comes to international markets. So, if you look at Germany and UK and European markets in particular, they are emphasizing a lot of investment into infrastructure. Specifically, the theme is they want the pensions, their internal pensions, to actually heavily invest in local infrastructure. You're also seeing that in Australia. So again, like that makes you believe in infrastructure globally and specifically in those countries because there's going to be a wall of money coming into those markets. Because similar to the gold theme where, there are structural trends that are driving that from emerging market economies that are driving that explosion of interest in gold. We think that, infrastructure is kind of that next big play. And similarly, around innovation, like it's a question mark, but I would be interested in seeing how, for example, like in India and other countries, like how does the VC sector evolve?
Thank you. One more question.
Okay, here's an outlier scenario since everything's been going so well. I believe next week the Supreme Court hears oral arguments about Trump's tariff legality. Question number one, do you have an opinion which way they go? Number two, what happens if the court decides, and whenever they come out and tell us, Trump does not have the authority and he's got to return all the money?
Then U.S. Treasury has to write I think it's $195 billion in refund checks. That's because that's the import duties that have been collected year to date, if I recall. I don't know how to handicap that. I personally, you want the Jeffrey personal view, not a constitutional lawyer or scholar. I think it's unconstitutional, the tariffs. I think it should be done by Congress. It's a tax, as I mentioned earlier. But if, let's say, it does get overturned, there probably are some other targeted tariffs that will still be in place, so won't completely derail that effort. So that's one thing to keep in mind. But beyond that, I think the main thing when I talk to clients, institutional clients, the main fear they still have is inflation. Tariffs causing inflation. So if you remove that from the table, then my inflation story that I tried to sell you all earlier really starts to look better. And I think that also will have an impact on interest rates, both the front end, probably Fed pricing would come back into view with less inflation risk, and even longer term rates as well. That would be the big implication for me. So you're right, it is an outlier.
Thank you. I believe we have time for probably one more question, right? Or what? Yeah, one more.
Seven more questions.
Fire questions. Any other questions?
What would you say is the best way to take advantage of those international infrastructure plays? I know that at Northern we do a lot of listed infrastructure. What else are you kind of looking at?
Yeah, I mean, it's two different markets. When you look at listed and unlisted infrastructure, listed is a lot more focused on utilities and more regulated markets. And if you look at unlisted infrastructures, I flew in from New York yesterday, and JFK Airport is a prime example of something that's in a few unlisted infrastructure portfolios that you couldn't invest in as part of a listed infrastructure fund. And so I think the deviation is that the unlisted private marketplace is able to give you a lot more access to things like digital infrastructure. So a lot of the data centers are only like less than 5% when it comes to listed markets. Although, I've seen both real estate and infrastructure managers claim that they own data centers because that's kind of the market that they want to be in. So it's debatable in terms of what part of your portfolio it fits into. We try to measure that exposure across the board. But outside of data centers and energy infrastructure, there's again a lot of different areas of the market that you just can't access anywhere else. So the example that I was giving in terms of international markets, a lot of that is largely targeted towards renewable infrastructure and development of digital infrastructure to power kind of the next economy, and that can only be accessed through private markets.
Thank you. I think I saw a few more hands in the back. Here.
Are any of the institutional clients trying to build more flexibility into their portfolio to kind of take advantage of what I hate to call in a simple term the taco trade or anything else? I mean, are people building more liquidity, or are they going to do that, or is that just a retail client option?
I mean, institutional clients, if you look at, I think they're still pretty short duration relative to where they could be if they thought rates were going to go a lot lower. And most institutional clients that I interact with, they're worried about Trump, but it's an inflation worry, as I was saying. So if he does chicken out or he gets overruled on tariffs, I do think it's a longer duration bias that will win out because it'll be an inflation story. And then people could extend out. I guess the other way to think about it is money market funds have now over $7 trillion in AUM, so that's up quite substantially. So that tells me just like a sign that a lot of people are still short and could move out the curve, could move into other asset classes. They don't have to move into bonds, of course, but that's one metric that I would point to.
Yeah, to your point, I was in a LP discussion recently, and we were talking exactly about that point, which is, are lines of credit enough in case you have a 2022 style denominator effect scenario where public markets are down, stocks and bonds are down, and you're getting all these pent-up capital calls given how much dry powder is still in private market allocations. And I think some people think that, okay, well, having experience like 08, 09, and even 2022, if you have sufficient lines of credit, that's usually enough. If you have some pocket built in, where you draw capital from, which could be a private credit sleeve or another sleeve, that's usually enough. But I'm not sure. I feel like the world is going to change in how we even think about liquidity and how we measure liquidity. And analytics around liquidity that don't exist. So how long can it take for me to liquidate or go do a secondaries trade in my portfolio? And how do I access that? So more and more LPs are trying to figure out the precision of liquidity measurement and integration into portfolios, rather than just think about, well, when that scenario comes, I have one of these options that I can access. And obviously, worst case scenario, you can always do a secondaries trade, but most LPs don't want to go sell at a discount, right? Like it creates headlines like it did with Harvard and Yale, and not always positive, but you want to be able to control when and how you sell your portfolio and the returns that you can generate.
Thank you. With that note, I think we're running out of time. Great panel, awesome conversation. Thank you so much for sharing your insights and historical knowledge as well. That was a lot of fun talking to both of you.
Thank you.